When you watch a stock price tick up and down, it feels exactly like a betting chip. It is a glowing number on a screen that jumps around for reasons nobody can quite explain, and you are simply hoping it goes up. That instinct, the feeling that the stock is nothing more than the number attached to it, separates you entirely from the physical reality of what you bought. You are not just holding a number. A company is a real physical thing. It has factories, it has heavy machinery, it has vehicles rolling off the assembly line, and actual cash sitting in a bank account. When you buy one single share, you purchase a strict legal claim on a fraction of all of it. The difficulty is that your fraction is so microscopic, it is almost impossible to feel. You own this specific tiny cell in a massive grid. To understand what a stock actually is, we have to look past the overwhelming scale of the corporation itself. We have to map the exact legal boundaries of your tiny claim and fix the one assumption almost everyone makes about it. People often summarize investing by saying, you own a slice of the factory. That is incomplete. Your slice is not the factory itself. The company did not build all of those physical buildings using only money from the owners. They funded a massive portion of it by taking on debt, loans, bonds, and bills they still owe. In the legal hierarchy of a business, lenders have a prior claim on those physical assets. They get paid first. So to find your true claim, we do some basic subtraction. We take the total assets of the company and subtract everything legally owed to those lenders. What remains is a specific calculation known as equity. Your microscopic slice is carved exclusively from this equity block. You do not have a claim on the gross assets. Because you shoulder the company's debts alongside its assets, your stock is strictly the gap between what is owned and what is owed. Let's follow a single dollar through the system. The company sells a product and cash comes in the top, but you do not get to touch it yet. The business immediately drains that incoming stream to pay suppliers for materials and employees for their wages. Next, it fulfills external legal obligations. It pays fixed interest to lenders and taxes to the government. The legal hierarchy dictates that every prior obligation must be completely satisfied before you see a cent. You are dead last in line. In finance, there is a specific name for this position. You are a residual claimant. Sitting at the absolute bottom of a payout ladder sounds like the worst seat in the house. It is actually the most powerful position for wealth generation. Every person ahead of you receives a fixed pre-agreed amount. Their upside is capped. Yours is not. You own all the leftovers. Buying a stock means purchasing the permanent legal right to every single uncapped dollar that trickles down to the bottom of this ladder, this year and every year the business survives. Let's map this theoretical hierarchy onto reality. Take a recognizable balance sheet, like Tesla. We see roughly $120 billion in total assets. We subtract $45 billion owed in liabilities, leaving a $75 billion equity pool. Divide that pool by 3.2 billion shares in circulation, isolating the exact physical value of a single stock. That gives your one share a strict mathematical floor. It represents exactly $23 of net owned factories, machinery, and cash. This is the structure of ownership. A share equals equity. The shareholder is last in line. Your value is built entirely on physical leftovers. And yet, if you look at a trading app, the market will gladly ask you to pay over $400 for that exact same $23 slice of tangible reality. Why the enormous gap? What specific psychological forces and market mechanisms convince a buyer to pay hundreds of dollars for a tiny fraction of that in physical assets? Recognizing the strict physical boundaries of your stock is the mandatory prerequisite for surviving the psychological illusions of the stock market. Next week, we look into the gap.